What's up guys, and welcome back to Drive to Thrive. In today's video we're going to be doing a follow-up to my last week's video where I discussed Apple. Now in that previous video, last week's video, I talked about Apple in kind of the longer time frame. What are some of these pullback areas I'm looking for and where I'm going to be getting aggressive. So if you haven't seen that video, make sure to check it out. But in today's video I'll be talking more about the short-term time frame and what I'm looking for this week. So if you're enjoying this kind of content, make sure to leave me a comment, drop a like, but otherwise let's go over to the computer and let's get started. Alright, so here we are on our daily time frame of Apple, and like I mentioned in my post on Facebook, where, by the way, if you guys aren't a member yet or you'd like to join the group, make sure to click on that description in the link below or on my YouTube page. But I mentioned this gap right here. You know, I had a really strong suspicion that we're going to come back and fill in this gap. Well, sure enough, last week we pulled back and then we used this 200-day moving average as our support. Now, going back to last week's video, I did mention those 200-day moving averages, not just for Apple, any kind of stock, are a really good indicator of it's either we have this bullish or a bearish momentum behind us. So if we are above that 200-day moving average, it is a bullish scenario, it is a bullish momentum. As soon as we start breaking that 200-day moving average, it's seen more as a bearish momentum. So far, this is where the battle is happening, right in this green area. You have the bears trying to take us lower and break beneath this $150 support, but this is going to be a nice tough support to break. And then you have those bulls trying to run us back up and retest the $175, possibly the $179 resistance up above. So kind of in this no man's land, not the best way to be getting in or out of this trade, but make sure to keep an eye out on what happens next. So two scenarios I'm looking for this upcoming week is my bullish scenario is we come up here, kind of tag this rising trend line from the bottom side, possibly see a reaction off of here, you know, come back, retest this 200-day moving average, and then bam, we run through here, come back a little bit again, pull back, and off we are on our way to this $174, $175. Similar scenario to what happened back here in July. We kind of came up, retested a trend line, pulled back, used the 200-day moving average, and then bam, on our pullback we didn't quite come back to retest it from the top side, but you did see a small pullback right here, and then, you know, running all the way up to $175. So this is kind of on my bullish, you know, scenario. And if this happens, I feel like it'd be more safer of a trade to put on a bearish trade, just because we're so close to this $175 to $180 resistance up above. And if I zoom out of here quickly and just jump over to the weekly time frame here, you see on our stochastic RSI there is still a room for this thing to run lower. We are losing that momentum to the upside here on our MACD, so I feel like there is more bearishness in this chart. So going back to my daily time frame for my bearish setup is look for something like this. You know, we come back up again, try and break through, right? You end up having that pullback, and then here is that second try, but on the second try we don't actually use the rising trend line as support, but we end up breaking through it. And this is our trap. This is where you want to start getting position and you want to put on a trade right here to call the top. So I'll be looking for us to fill this small gap right here if we ever get up here, but around $164 is what I'm expecting for us to kind of top out. And this is where I'll do a bear call spread, is where I'll be calling that top at about $165 in this particular case. If I go over to my options chain right here, so I chose the Friday, October 14th expiration day. And the way I'll structure this trade is I'll be going into the calls and selling the $165 strike and then buying a protective put at $170. And this will give me a defined reward and a defined risk. So if I was to do it today, you know, with the stock price being where it is, around that $157, my reward would be $113 and my maximum risk on this trade would be $387 using one contract of each. Now, the closer we get to that $165, the more that credit spread is going to grow. Possibly we'll get up to a $200 credit spread, which means our maximum risk would be somewhere around $300. So This is what I like to do. This is the kind of trades I like to play during this kind of market or any kind of market, because you can do, you know, these spread trades during bear markets, bull markets, stagnant markets, doesn't matter. Now, if you want me to kind of discuss these trades a little bit more in depth and kind of let you know how I structure these, how I look for the strike prices to sell, let me know in those comments below and I'll do like a detailed video. But for this example, I would be selling the $165. So like I mentioned, just around here, as long as Apple stays below $165 before expiration, I would get to keep that credit. So that is what I'll be looking for this week. Again, I do think the 200-day moving average is going to be super important. This is where all the battling is going to happen. Do the bears win and take us lower, or the bulls win and take us higher? So that is it. If you have a crystal ball and you know what's going to happen this week, let me know. I'd love to put some YOLO trades out there. But otherwise, I hope you found this useful. If you did, smash that like button and I'll see you in another video. Ciao.